Well, there's good news for anyone who wants to borrow money. A change in how Fico scores are tallied will make it easier for millions of people to get loans. The newer Fico scores will no longer weigh medical debts and will ignore any collections that have already been paid. These changes will happen come the fall. Here to talk more about it is Doug Butler. He's the Vice President and Director of Research from Rockland Trust. He joins us from our Beacon Hill studio. And Doug, let's talk about this. Why is Fico making these changes?
Well, two reasons, really. One is the government really wants them to. The Consumer Financial Protection Board has really been pushing FICO to improve lending to people who have been out of the credit markets for some time. Since the recession, essentially lenders have been really lending only to the best credits. And the other thing is they found that borrowers generally who pay back a collection or who just have medical debt end up being relatively good credit-worthy people.
So they're trying to open up the field here a little bit more and expand it because, as you said, you might have had one blemish, maybe two. You made amends for it, and there's no longer a need to penalize these people any further, and perhaps you can get more skin in the game.
Sure, I think that it enables people to borrow a bit more, enables people to have a little more access to, both credit cards and auto loans and particularly mortgages. And that really will, hopefully enhance the economy as a whole.
Now, I don't have to tell you what happened back when the Great Recession came through, and we know what happened there. People who probably shouldn't have gotten these loans got them, and that's going to be the concern on the other side of this whole equation is, but, there are people who just are not credit worthy.
Right, and there definitely are people who are not credit worthy, but really, I think we've all had issues with, your doctor, your insurance company sort of fighting over it and sending you 27 bills, and you don't know which one to pay. And they found that people who really it's only a medical issue, they really generally end up being an okay credit. That isn't to say that there are plenty of people who are deadbeats and will continue to not pay their bills, and this is not going to improve their results.
Certainly. All right, I want to talk about something else too while we have you, and that's rather disturbing. I mean, to say the least. Nearly 1 in 5 people near retirement have zero money saved. The Federal Reserve surveyed more than 4,100 people to come up with that number, but 19% of people between the ages of 55 and 64, and I couldn't believe this, those closest to, of course, the retirement age, reported that they have nothing.
Right.
So what's going on here?
It's very scary. I mean, again, for that cohort that's really approaching retirement to strictly be counting on Social Security, and we all know Social Security is not, is not the panacea.
That's winding down as well.
That's going to be, that's going to be tough. I think a lot of these people are going to, and especially in that older age cohort, are going to have to plan to work longer. Actually, across the board, we're probably going to have to work longer. And I
think most people get that now. I think they understand that, 65 is a number that their parents may have had, but certainly not people today who are going to work on a daily basis. That's a number that just seems unattainable. You're thinking in your head 67, 70, plus there are so many more benefits to working a little bit longer.
Yeah, there are a lot of benefits, both health benefits and in general, people do better the longer they work. And I think the good thing to think is everybody should be thinking 70 is the new 65.
I think you're right, orange is the new black and all that stuff. All right, but let's talk about saving, because they say you got to save when you're young and keep saving all the way through and you won't have the problem that we just talked about. But the problem is with student loan, for example, it saddles these young people who can't, they're paying off their loans, they're paying off their rent, they're buying some food, and before they know it, they don't have any money to save. What do you suggest they do?
I think, one of the things is really people, if somebody who's 35 years old, I think the studies have shown that they need to save 15% of their take-home pay if they want to retire at 65, and this gets us back to our previous point. If they change that age to 70, you only need to start saving 6%, and 6% is a manageable amount that most people can do.
What about people on a fixed income?
Yeah, the retirees, if you're in retirement, you really have some troubles, saving money. I think there are 2 real key factors you can do. One is really look at your health insurance, and there's a number of things through the state health insurance program that you can look at, as well as if you own your own home, you can get property tax abatements. Lots of towns and communities really look to file for those. And there are senior work-off programs. Those are the key components that I would say for seniors looking to cut their costs, who's dealing with a fixed income and really only have, a set amount of money coming in. Those are their quick and easy solutions.
Very good. Some good advice. Doug Butler, the Vice President and Director of Research from Rockland Trust. Thanks for coming in on Friday. We appreciate it.
Thanks a lot. Bye-bye.
And Sobani, over to you.
So do you tell your teen to focus on the road when they're driving? It turns out